Hello everyone. Today let's look at the different types of moving averages which are used in technical analysis by traders and technical analysts. First, let's look at the simple moving average, also known as SMA. A simple moving average is an arithmetic moving average calculated by adding recent closing prices and then dividing that by the number of time periods in the calculation average. A simple moving average that is calculated by adding the closing price of the security for a number of time periods and then dividing this total by that same number of periods. The short term averages respond quickly to the changes in the price of the underlying, while long term averages are slow to react. Here we have given a table depicting how the simple moving average would be calculated and how the trend would move on. Now next let's see the exponential moving average. An exponential moving average, also known as EMA, is a type of moving average that places a greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponentially weighted moving average, and this moving average reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in the period. Let's look at an example. And the red moving line here, the red line is the exponential moving average, and the darker line is the simple moving average. And as you can see, the price changes through the candlestick patterns. The red line adapts to the price changes faster than the blue line. Now let's look at the double exponential moving average, also known as DEMA. This is an indicator, and it's one of the technical indicators used using the exponential moving average EMA of a stock price to analyze and predict future price movements. Although this indicator is called the double exponential moving average, the equation does not rely on using a double exponential smoothing factor. Instead, the equation doubles the EMA but then cancels out the lag by subtracting the square of the EMA. Next, let's look at the triple exponential moving average, also known as TEMA. The triple exponential moving average was designed to smooth price fluctuations and filter out volatility, thereby making it easier to identify trends without the lag associated with moving averages. Many traders find it to be useful tool in identifying strong long-lasting trends, but it may be of limited use in range-bound markets with short-term fluctuations. The formula for calculating the triple exponential moving average is given here. Here is an example chart of the triple exponential moving average. As you can see, the blue line, which is the TEMA, it follows the changes in prices of the candlestick patterns. And this is how, if we chart the TEMA, it will move and it will help in prediction. Let's look at the linearly weighted moving average. The linearly weighted moving average is a method of calculating the momentum of the price of an asset over a given period of time. This method weights recent data more heavily than the older data and is used to analyze market trends. Some analysts find that while an exponential moving average functions best as an indicator for performance in the near term, a weighted average can be useful for analyzing performance over longer stretches of time. Next, let's look at the moving average ribbon. Moving average ribbons are a series of moving averages of different lengths that are plotted on the same chart to create a ribbon-like indicator. Traders can determine the strength of a trend by looking at the smoothness of the ribbon, as well as identify key factors of support or resistance by looking at the price in relation to the ribbon. Moving average ribbons are often made up of 6 to 8 moving averages of different lengths. Most often, traders use simple moving average ribbons that are set at 10 period intervals, such as the 10, 20, 30, 40, 50, and 60-day moving averages. Here is an example of the moving average ribbon, and here you can see the number of moving averages that have been plotted on the chart, and they show how the trend has moved. And this helps analysts to identify the trend and determine the support and resistance levels. Thank you for watching this video. For more videos like this, please subscribe to the channel. And if you would like to create an account for trading, you, we have given a link in the description which you can use to create a free DMAT account that will help you with trading.